Okay, no change. 9-10 points lower is what we have as far as the Nifty is concerned. Manishi Raychaudhuri is joining us right now. He's with BNP Paribas. Manishi, thank you very much for speaking with us here on CNBC-TV18. Just to put forward your overall stance first. Where are you at? You were bullish on India earlier, and you seem to have revised that stance a little bit on the other side. What's caused it?
Little more than a week ago, we upgraded India to overweight. You would remember that in late June 2018, we had downgraded India to a neutral because of primarily three concerns. At that point of time, the concern on currency depreciation was supreme because of oil prices going up. Second, we were also seeing a declining trend in earnings estimates and quite a severe decline, more than what we were seeing in Asia ex-Japan. And third, there was pretty much no sign of any of the stronger macroeconomic drivers reviving. For example, we were not seeing any sign of private capex, and the cost of capital was relatively high compared to the rest of Asia. I think the last two are clearly beginning to change, while the first one is clearly behind us. We don't really have much of a concern on the currency anymore. We think that despite the recent slight rise in oil prices, it is clearly within manageable levels. Second, we think that private capex is possibly on the cusp of a revival. The capacity utilization has gone up, and cost of capital is gradually coming down, with the Reserve Bank of India having gone through 2 rate cuts and possibly one more in the second half of the year. The decline in cost of capital raises the possibility of the gap between return on capital and cost of capital increasing going forward. So we think that the earnings estimates, which were declining till recently over last 1.5 to 2 years, are possibly in the last leg of that declining phase. There are a few sectors where the earnings estimates, the consensus earnings estimates, still appear too high for us. I think for India as a whole, it's still about 19 to 20%, and we think it'll come down to somewhere around, let's say, 14 to 16%. But the bulk of the earnings downgrades are possibly behind us. These are the factors that led us to upgrade India to an overweight in late March. And, I think the recovery in fund flows that we are seeing now is going to be an additional tailwind to these fundamental factors.
So where, and of course, flows in the month of March, etc., have been pretty good. We got the local domestic equity flows as well, the numbers yesterday from AMFI, and that has also picked up quite a bit. Where will FII money really go from here? Large caps again, or are you seeing interest once again in the broader market, mid caps, etc.?
Well, the bulk of the money would have to be, directed at the large caps, because that is where the larger trading volumes lie. Yeah. Having said this, we think that the mid caps, primarily because of their severe underperformance in 2018, are appearing much more attractive than they used to, even though they have bounced back slightly over the last 1 month or so. As far as the mid caps go, we are unwilling to paint that sector with a broad brush. We would rather focus on certain companies or stocks which have a history of generating higher returns than cost of capital. So a history of generating excess returns, history of generating free cash flows, and are of better quality compared to their sector peers. So in the mid-cap space, we think investors should be selective, but there are enough opportunities right now as a consequence of the relatively attractive valuations.
Okay. Manishi, which are the sectors you're focusing on, say in the large cap as well as the mid cap space?
We are positive on the financials, unequivocally. We think, and our weight in the model portfolio is concentrated on the private sector banks. But one important change that we have made is that we have moved a little more into the corporate lending private sector banks. Earlier, we were focused entirely on the retail lenders. Right? So we think that that is one area that investors should play. Selectively, investors could also play the NBFCs over there. The second important sector that we're focused on are the consumer discretionaries, which include select few autos as well, even though the auto sector is not really doing well right now and such underperformance could continue for another quarter or so. But the consumer-focused sectors, particularly consumer discretionaries, is another sector that's on our radar. Apart from that, we think select few oil companies, engineering companies, and even IT companies could do well, even though IT is one sector that we're de-emphasizing right now.
Okay, de-emphasizing IT. Can you give us a little more perspective in terms of what your outlook on IT is? And, you know, we have earnings kicking off this week from the majors.
Now, historically, whenever there's a slowdown in the US or a slowdown in certain segments, sectors of the US, which are large contribute to IT revenue, we have historically seen a commensurate pressure on the revenues of the IT companies also. Usually, that pressure comes with a time lag of somewhere between 1 to 2 quarters. So one could say that in the second half of calendar 2019, the revenue growth for IT companies could face some pressure. Now that said, the point that these IT companies have made, that have increased digitization, that could potentially stymie that pressure a bit. Now having said that, not too many companies are likely to make a success of that business initiative. So I think investors would have to be selective in this area, and we must not forget that the big tailwind of 2018, which is rupee depreciation, is no longer working in favor of the IT companies. And that is why, you know, even in our Asian model portfolio, we have actually reduced our emphasis, the weight on Indian IT companies considerably.
Manishi, one sector is where there has been pressure, has been auto. Both businesses have slowed down, and of course it's showing up in stocks as well. What lies ahead there? Indian passenger vehicle makers are seeing new entrants, competitive intensity. So talk about autos to us a little bit, and also cement. We've heard recently from some that it's a sector which has been which hasn't got its due over the last couple of years. Is that a sector you would look at?
The second one is easier to answer because we don't have any exposure on this cement sector right now. We think that the question about oversupply that we have seen in that commodity-driven space, that is likely to continue somewhat longer. Now, having said this, this oversupply is sort of localized. It's more in South India than in northern or western India. But I think that sector is difficult to play because even the companies which are operating in the relatively better geographical areas, they appear overvalued. So that is as far as the cement sector is concerned. Auto is relatively, I would say, relatively more difficult to sort of navigate through at this point of time. Because while right now the growth picture does not look too encouraging, at some point of time, given India's demographics, given India's nominal GDP growth rate at about 10 to 11%, which is pretty much the same as the per capita income growth rate, structurally, auto sales, both in two-wheelers and passenger cars, should pick up. Over past few years, we have seen extraneous factors like, the OROP in the defense payments or the seventh pay commission. That has boosted auto and two-wheeler sales. We don't have any such, consumption supportive mechanisms visible in the horizon unless we, get into competitive populism, which would not be a very favorable outcome for the macroeconomy as a whole. But at the same time, we think that over the longer term, the growth picture should revive, and therefore the companies which are market leaders in their segments, which have very strong distribution or very strong product offerings or both, they're possibly the best bets for investors.
Okay, all right, Manishi. On that note, we're going to wrap up the conversation. Always a pleasure hearing your views. Thanks very much for joining in and speaking to CNBC TV18. Ashwini Gujral now joins in to discuss the technicals of the market. Ashwini, over to you. What are you recommending in terms of a strategy for the Nifty and maybe even for the IT stocks today?
Well, this 11,500, 600. This zone has, multiple supports for the Nifty. Also, the Bank Nifty is not falling the way it was yesterday. So my sense would be to, try to accumulate long positions in this zone and then just wait for this correction to play out, because the bears have not been able to really break down this 100-point range, and I would think that at some point the Bank Nifty comes back, and with the Nifty IT outperforming, you should see upside more upside at some point than downside. Having said that, Yes Bank is a buy with a stop of 260, target of 274. ITC is a buy with a stop of 290, target of 306. And Jubilant Food is a buy with a stop of 1410, target of 1465.
We've got a question coming in from a viewer, Ashwini. Sunil wants to invest in Excel Industries, and he's also got interest in Asian Paints. He wants to know which of them is a good bet with a long-term view. Well, that should be an easy one. Ashwini?
See, Asian Paints is a good buy when when oil prices are high and people are generally not bullish on these paint stocks. You could say 1150 type of rates. So I don't think right now Asian Paint is a good one. Excel Crop Care, is that?
No, Excel Industries. The one at 1160.
Okay, now Excel Industries, it's a low volume stock, plus it's below its 200-day moving average. If you buy here, at least keep a stop of about 950, and this is the kind of stock which in a good roaring bull market in the mid caps needs. So whether it'll immediately do something, that looks difficult. I think waiting for Asian Paints to come off is a much better bet.
Okay. All right, Ashwini, we're going to let you go on that note. Thanks very much for joining in, taking us through all of those strategies, those technical calls. For the Nifty, 11,587 is where it's at. The mid cap index down 100.